Fantastic, thank you.
No worries. So the Oxford Union is, as you know, the Speaking and Debating Society here at the University of Oxford. And when it was initially founded, it was a platform for free speech and debate. And to this day, we host weekly show debates, as I mentioned earlier, on a range of topics. Your colleague Dan tipped me off earlier this week that you're in fact a huge fan of debate. Where does this passion stem from?
Yeah, I spent most of my high school doing debate.
Okay.
It was the team that I was on, and I started freshman year and spent an incredible amount of time preparing for the annual topic and competing throughout the state and sometimes throughout the country. And it was just my main activity in high school outside of my academics.
And do you ever use that in your career today? Do you find that skill useful?
It is. It is a skill that is useful because the fundamental skill of debate is critical thinking and analysis. And it's to hear something and to react to it relatively quickly and to assess the truthfulness of it and to question the validity of it and to be able to sometimes argue both sides of it, because a lot of the debates, you'd go to a tournament, there'd be 8 rounds and 4 times you'd be arguing one side and the other 4 times you would be arguing the other side. Yeah. So you had to see both sides and be able to advance an argument. And that translates through to just so many things that you do. You need to know, in my business in investing, you're buying a stock and someone else is selling a stock. Well, right there, that's like a debate, right? Is the stock going to go up or is it going to go down? Yeah. So being able to have a skill that you've honed on being able to argue both sides of that proposition allows you to sometimes be able to look at something and say, okay, this is the side that I'm picking on this particular argument.
Yep. Have you ever had that instance kind of where you're picking a stock and you've had a complete change of mind and a reversal in the approach that you initially took?
Yeah, we're wrong all the time.
Okay.
I shouldn't say we're wrong all the time, but we're wrong often. And we have to constantly question whether we're wrong. And so there's lots of times that come along where you buy a stock and then a certain amount of time happens or different events happen and you have to look at it a different way and say, nope, sorry, that was it. We should have done the opposite of what we did. And then you change course.
Okay, so slightly different question, but you studied government, as you mentioned earlier, and then you went into the finance industry. Did you ever consider another career path?
Yeah, after my undergraduate, I had written a thesis. It was in the government department, but it was largely, it turned out to be almost an economics type of thesis. And I was very interested in that, and I wanted to go get a PhD in economics. Mm-hmm. And I applied to several schools, and they did me a huge favor by rejecting me, which allowed me to go towards the career that I've gone to. Okay,
so never kind of a career in government or something related in that area?
Yeah, even though I studied it, and I easily could have gotten involved in the academic side of it, I never really envisioned myself as truly like part of the government or part of the politics or process like that.
Okay, and then how did you get started with the business, and how did you take Greenlight from the 2-man operation that you started with to the huge hedge fund that it is today?
A lot of it was due to really not having a lot of planning, but being able to be in a particular situation, in my case, getting also then a fair amount of good fortune, and then adjusting to the circumstances that were there and making what I think turned out to be good decisions.
Okay.
And so, I had the happenstance of, being at a fund where I got some good training, and then also at the same time realizing at a point relatively early in my career that I didn't really have a long-term future there. Yeah. And so the fellow who was in the office next to me kind of had the same view about his career, and we went out for coffee one day and decided to walk out and start our own. And 3 weeks after that, we were in the snow in January in Manhattan looking for like a Starbucks to sit in to make some phone calls to people and get the business started. And we did not have enormous aspirations, but we felt that the way the industry is set up, there's very low barriers to entry, and we felt that even with a small amount of money, if we could do a good job with it, we could make a good enough income stream that we would have a satisfactory life. And I never in a million years would have guessed that the thing would have turned out the way that it has.
Yeah.
Yeah, that was never an aspiration. It just worked out that way.
I mean, great that it did, right?
Very lucky.
Yeah. Yeah. So if you had to say there was one sole reason for Greenlight's success, what would you pin it down to if you had to pick one?
If I had to pick one, I think it's critical thinking skill. Mm-hmm. And it's the ability to look at a situation and see it for what it is, which isn't necessarily what is presented to you. And when something makes sense, to figure out what makes sense, and when something doesn't make sense, to question it, to challenge it, to look at it from a different way, and to often come to the opposite conclusion. And you don't have to do that very often. Like, 'cause most of the time when someone tells you something and it makes sense, it just makes sense, and that's that. But sometimes it really doesn't make sense, or there's another side to it. And when you can come to a view, maybe just a few times a year, where you have an important difference of opinion with what everybody else is thinking about a particular situation, if you can figure that out and figure out that it's important, we've been able to make a small number of large investments that the vast majority of the time have worked out very well, because we really have had an important difference of opinion between what we think and whoever's on the other side of that transaction when we enter it.
Okay, and how would you say that's translated into Greenlight's culture as a firm?
I mean, the culture as a firm, it's very, we're a lot of smart, nice people. We interact well. I think there's a lot of humility. I think that people respect one another. People respect one another's views. People respect me. I respect them. I respect their time. Which I think is I don't want to call it unique, but it's an unusual management culture for senior people to truly respect the time of junior people and so forth. And so you wind up with a group of people that are critical thinkers, that think and reason things out before that they speak, that can adjust to new facts, that can adjust to feedback, and can work well within a culture, and that's what we have.
And so would you say that's in contrast to kind of the rest of the finance industry?
No, I wouldn't contrast to the rest. We are our own, and there's a whole continuum. There's probably even people who've done what we're trying to do even in a better way. So I don't want to say that we're unique, but we do it our particular way, and it works pretty well for us much of the time. And from there's a whole continuum of different types of work cultures and traits that people are looking for.
You said you worked in investment banking earlier. How did you find the culture there? Do you think the culture in that industry has changed? Do you ever see it changing?
Yeah, I worked in investment banking for 2 years. I was in the program where they kind of just own you. And you I didn't realize I signed up for that, which was one of the problems. I didn't know anybody who'd done this, and I grew up in the Midwest, and that meant that like everybody's dad was home for dinner, and certainly on the weekends, and I didn't know from these kinds of work environments. But the environment there is you show up and you're in a division, and there's 200 people in the division, and by definition all 200 of them have been there at least one day longer than you, and anybody who's been there one day longer than you is your boss. And so you have 200 bosses. And if you're not good at figuring out like how to like manage people's expectations, if two people tell you to do opposite things at the same time, for me this was something I was never able really to wrestle to the ground in a way. So I wound up not really succeeding within that culture. And the other side of it was the culture therefore was very disrespectful of younger people, because if you were the senior person, it meant that you had once been the younger person and you'd had that experience, and you were almost obligated to inflict upon them whatever had been inflicted on you, sort of as a rite of passage, as if this was like a growth thing. And I never really understood that, and I kind of think from a management perspective, I've looked at it and said that's like a negative example. And so sometimes the best lessons you have in life are when somebody does something and you say, I would just do the opposite of that, were I to be in that person's position. And I've tried to do that as I've become a manager of people within my own firm.
Mm-hmm. Okay, so I guess leading on from talking about culture in the finance industry, we're coming up to 10 years since the global financial crisis. Do you think we've learned our lesson?
Do we think I've learned the lesson from the global financial crisis? It depends on what one thinks that the lesson was, unfortunately. As I looked at the global financial crisis as it happened, I thought that there were 3 or 4 or 5 really obvious problems, structural problems that were exposed. You had institutions that were thought to be able to fail, but in fact they were deemed to be too big to fail. Mm-hmm. You had some of so-called structured credit where risk was being transferred, but it wasn't really being transferred, and it wasn't being properly evaluated. You had the problem of these credit rating agencies which were being that there's really only 2 or 3 major ones, what you wind up with is a centralized decision maker as to who's creditworthy and who is not creditworthy. And that's a really bad way to allocate credit. What you really want is a large number of people evaluating each credit to determine the creditworthiness, rather than having 1 or 2, because if you have 1 or 2, you create crises of confidence when the 1 or 2 change their mind, and you lose the opportunity to go out into the market and find other people who might look at it differently from the credit rating agencies. And that's separate and apart from the corruption that was involved there relating to the AAA ratings and the structured product like that. I think there was a lesson that was learned about derivatives, and derivatives could have been dealt with differently. And what we've done instead is we've created a clearinghouse for derivatives, which essentially has created yet another too big to fail institution where all the credit is on an undercapitalized entity that everybody assumes, you know, will perform under all circumstances, when of course it can't, as counterparties begin to actually have problems. And so from my perspective, if you took like all of the obvious problems from the financial crisis, we really kind of solved none of them. And we went a different way, and we basically went the bailout route and said we're going to create a whole lot of moral hazard, and we're going to sweep as much of this stuff as in the under the rug as we can, and we're going to move on as quickly as we can. And so, and that solved some things in some ways, but I think it has left the basic structure more or less as it was, and I think that it is susceptible to the same type of event or series of events sometime in the future.
When you say sometime in the future, would you put a number on that?
Whenever the next down cycle occurs.
Okay. Okay. So growth has done very well against value in recent years, and you recently appeared in financial news headlines when you told your investors that Greenlight's reliance on value may have been wrong. Do you think that this trend will reverse, and how have you coped with adjusting your own investment philosophy after so many years?
Okay, this is the problem with communication. Sometimes when you do what is called rhetorical writing, or ironic writing, or maybe even slightly sarcastic writing. And so I wrote a missive to our investors in our quarterly letter, and I was a little bit sarcastic, and I think many people understood what I was trying to say, and some people took it absolutely stone cold, Amelia Bedelia literal, and came to the opposite conclusion of what I was saying. So what I was basically saying is look, value investing over time has worked. We think that this is the best and right way to invest. It's not going to be true every day in every environment. We are in an environment right now where it doesn't seem to be working at all. And in fact, the opposite seems to be working, because people are looking at things and saying the ownership of a company is something other than the risk-adjusted future profits of the company. Maybe it's the social disruption, maybe it's the social desirability, maybe it's the charismatic value of the CEO, or whatever it is that you have that is contributing in the market's mind to the equity value of these companies. I would equate this sort of from a decade ago, when people thought that companies should be valued based on how many eyeballs were watching on their screen. And so I think that this is a cyclical phenomenon, and people would like to say it is different this time. Our philosophy is that it's not different this time, and at some point this will revert. But nonetheless, sitting watching the portfolio trade every day and watching companies that don't make profits, don't have real prospects of making profits, may not even exist for the purpose of making profits, have the values of those stocks going up a lot, while other companies that have the misfortune of actually trying to earn a return on capital and pass some of that on to their shareholders see their stocks derated and devalued in the present environment. It's a challenge to our strategy as long as that persists. And our results over the most recent period have certainly suffered because we've been investing the more traditional way. At least that's the way I would describe it.
Okay. And speaking of kind of disruptions to the market and kind of new firms coming along disrupting what currently exists, what do you think is the next big technology that will disrupt the landscape that we may not even be aware of?
I have no idea. It's not really my field of expertise, and I certainly would not be the first person to tell you about a technology that all of the scientists, data scientists, material scientists, engineers, physicists, computer scientists that are sitting in this room, are spending all your time on. You know what technology is more likely to be changing the world than I do. That's for certain.
Okay. So moving quickly on then, you're an avid poker player. And so what's your approach to risk, both when dealing with cards and chips and then when dealing with stocks?
Yeah, investing in a poker game and investing in stocks, at least the way I do it, it's a very similar skill set. Mm-hmm. You are having certain facts that you know. In stock investing, it is whatever objective information you know about a company or a situation. What is the stock price is a good one. But also what the company does, what their sales are, so forth. These are objective things that you know. And then there are things that you can surmise, but you don't really know. You're making an implication. So that would be, what is the motivation of the CEO? What is the strategy? What are the various interests that are there? What does the competition look like? These are not objective. These are things that through work and you can make an educated guess about, but you don't really know, right? And then you have a range of things that you don't know that are going to come in the future, which are future events that are fundamentally unpredictable, but they live within a range of possible future events. And so you combine what you know with what you think you can surmise, combined with understanding the range of outcomes relating to the uncertain things and saying, is this a good place to commit a fraction of my capital? And then you could translate that to poker. There's what is it that you know? You know how many chips you have. You know what cards you're holding in your hand. If there's cards that are displayed face up on the table, you can see what those are, right? Then there's things that you can surmise. What are my opponent's cards likely to be? Is it how he is betting the hand? I can get information that way. Or by sitting at a table and playing with him for a while, I can see what his personality is, what his style is, what his skill is, and I can make inferences about the present hand based upon his past behaviors. So those are things that you're trying to deduce. And then there's the uncertainty, which is the range of future cards that are concealed in the deck that are yet to be displayed, that are important, right? And there's a range of those possible outcomes. And you take a look at all of those things, what you know, what you can surmise, and the range of outcomes, and say, do I want to, play this hand? Do I want to bet chips into this hand, and so forth? Okay. Sure.
Yeah, and then kind of leading on from taking risks through playing poker, you're also known for donating your winnings to charity. So you founded the Einhorn Family Charitable Foundation. Do you want to tell me a bit more about this and the causes that you've chosen to raise awareness for and why you're passionate about those causes?
Sure. Our charitable foundation, it has a professional staff of 7 at this point, helping me make good decisions in allocating philanthropically. We have one theme. The theme is helping people get along better. Mm-hmm. And we define that very broadly. I would say when you think about what that means, from our perspective, we like to say we are in the fire prevention business, not the firefighting business. So you don't go into the middle of a war somewhere where people are shooting each other and say, hey, everybody, we're going to help you get along better. It's kind of a little bit too late for a philanthropic interest. Mm-hmm. But there's things that you can do that make those kinds of things less likely. So you can build understandings between peoples and shared experiences and bridging differences and creating pro-social skills and social emotional learning and parents bonding well with their children and people bonding well within the community and welcoming immigrants and things like this. And so we basically break the philanthropic interest into 3 different areas, which we basically call, from birth up through, schooling, and then there's school age people, and then there's campus and community. And so we have a group of different entities that we support for different purposes, within that range, and we built like a nice portfolio of things that we support.
Through kind of partnerships with other organisations?
Well, we don't actually do anything. We are a granting organization. So we give grants to other philanthropic organizations that are well aligned. We tend to sometimes ask for very specific grant proposals. So there's a reason, like if you ask for money for us, you're going to take the money because you're going to do a particular thing. And then we're going to fund that particular thing. But sometimes we just like the organization and we will donate for the infrastructure and overall general support of the organization as well.
And kind of thinking a bit more about the aims of the foundation, where does the focus on empathy stem from for you personally, I guess?
Well, empathy, it's a core skill in getting along with other people. There's other core skills as well, but empathy is certainly one. If you can understand where somebody's coming from or why they're feeling a particular way and relate to them on that basis, it bridges.
Okay, and where next? What other causes are you having a look at? Have you ever thought about expanding internationally?
We've done a few things internationally over time, but it actually turns out there's really plenty of people not getting along well enough right where we are. And so we tend to be focusing, the closer it is, just like with the investing, the closer it is to where we are, the better chance it is that we will understand it, we'll understand the people, we'll understand the likelihood of being able to make a contribution that will make a difference. And so our bias is towards being closer to home whenever possible.
Okay. Do you have a particular moment that stands out for you through your charitable work, or a particular cause that you've donated to that stands out for you?
I don't think I have a personal moment. I tend to be away from, in a certain sense. I get involved in the decisions and the grant making and the allocations and involved in supervising the structure and the strategy of the team, but I do not tend to, participate directly on the ground.
Okay.
Yeah.
Do you think, going back, say 20 years, would you have known then that you would have had an interest in the kind of world of philanthropy and that you would have given so much to these causes? No,
because I had no idea that the kind of opportunity to do that was in front of me.
Okay.
I'm truly surprised, and it's a blessing and an honor and a privilege to be able to have this aspect of my life, which I never would have forecast.
Okay, and we've spoken about kind of what next in the philanthropic area. Where next and what next? Kind of with the financial career, what is it that motivates you to carry on managing the fund? And kind of where next?
Well, I love it. I love trying to solve the puzzles. I love trying to find the investments. I love trying to figure out what it is that is motivating a situation where we have a difference of opinion. People ask, what is the most exciting part? Is it like when like you have some company and you're proved right? Is that the most exciting part? That's actually not the most exciting part. That's not a bad part, but that's not the most exciting part. The most exciting part is when you think you figured out the joke. And you kind of get the joke and you understand what it is that you're doing and why it is that you have an opportunity now where you're going to be able to deploy capital and it's very likely to work out well. And those situations come up few and far between when you really have it. And it's really, really exciting because then after that, then it's just a question of watching it happen.
Mm-hmm. So where next? What are the plans? Where are you, international expansion with the fund?
No.
Which are there particular areas that you're looking at investing in next?
No, at the moment we're trying to do well with what we have, and that's proving to be very difficult for us in the current environment. We are invested in domestic markets. In developed markets. Okay. So we will invest in Europe. We will invest in Japan. We'll invest in Australia and Canada and the United States and maybe a couple other places that are developed markets that I'm not thinking of. But that's the vast majority of where we are. And I have no aspirations to get further away because I find that once you get into places further away, you're subject to what's going on with the insiders, and there's local rules and there's local customs and there's local knowledge, and it's very, very hard to compete with that sitting in New York, even if you get on an airplane and go and visit once in a while.
Okay, sure.
Sure.
So from there, shall we open up to questions from the audience? So if anyone has a question, if you'd like to raise your hand, and we'll try and go through as many of you as possible. First hand right up there at the back.
I have two questions on the current market environment. The first one would be, you said that the barriers of entry were very low when you entered the market. And I wonder whether that's still the case today, or even especially the case today with a lot of money in the market. And so my question would be, are those barriers to entry still very low? The second question would be, you said that the rules of valuation of companies seem to be somewhat off today and that there's a cyclical moment. For you, I assume that means right now you have to differentiate between firms that have a joke and firms that are just highly valued by this current market environment. What are the specific difficulties of doing that, telling the jokes from the weird ones?
Yeah. Look, when I started, there were people who started their funds and they said, in order for us, it depends on what your structure is and what you're doing. In order for us to be in business, I need to be here. I need to have, 5 different industry analysts helping me. I need a chief financial officer. I need 3 assistants. I need a lawyer. I need somebody to program computers. I need a couple traders. Before you know it, you're hiring 10, 15, 20, 40 people to launch a fund. If you're going to do that, you need to launch with a certain amount of capital so that you have enough income from management fees in order to fund the getting going of the business. That was true then, and I think it's true now as well. So if you are going to create an elaborate organization, you need to have the fees that create elaborate organization. And the barriers to entry then were not zero, and the barriers to that now are not zero. You have to figure out where that initial pool of capital is going to come into. But just like then, if somebody was going to give you, or you had a way to raise a couple $100 million, you could do that then. And if you know where you're going to get your first couple $100 million, you can do that now, and you can compete on that basis. Our thing wasn't really like that. It was me and another guy, and we were in an office, and it was 130 square feet, and I kind of had to suck in my gut to get between my desk and the file cabinet to get around to my chair. And we were at a T-shaped desk, facing each other with computers. Back then we shared an AOL email account, and we sent the monthly result, which I personally did, by fax that was on the radiator. So my partner would calculate the result, print them out, hand them to me, and I would fax them one at a time to the investors. That was where we were technologically back then. We probably weren't even state of the art at the time, but it's the way it was. But I'll tell you that with very, very small amount of assets under management, you could do that because there was nobody that needed to be fed. There was not a lot of expense. I literally wrote a check for $10,000, and my partner wrote a check for $10,000, and that purchased for us the filing cabinet, the television, the computers, whatever it is that we needed. And the rest of it, we made a deal effectively with our brokers and so forth to, kind of get us going with a little bit of infrastructure, like a copy machine and a coffee maker. And I think you could still do that today. And if you had a differentiated strategy and articulated it well and developed a client base and had good success that backed up the story, I think it's completely replicable now, just as it was for me like 20 years ago. So it's a question of what it is that you're trying to do and what kind of barriers entry there are in order to do that. So I'm sure there's regulatory changes and other changes that have made it. But on the other hand, there's a whole industry that along the way has developed, which is capital introduction. And you have these big banks that if they decide that they're going to back you, they will get you in front of 50 or 100 potential clients, and you can tell your story and raise that initial capital. And we didn't have that back then. The industry was not as developed, so we had to do it a different way. And ultimately, when we told our initial story, literally 3 people or 4 people signed up. And that was it. And they signed up for a small amount of money. And the good news was we just kept telling our story, and the results were good. And some of the initial investors, one of the initial investors, after 6 months said, "Hey, you did a really great job for me. Here's my 15 friends. Tell them I called, and go meet all of them." And that kind of word of mouth is how effectively we were able to build our company. The second question, you have to remind me because I talked too long.
There was how you decide, how to differentiate the jokes against the companies that are just highly valued in this currently weird market.
Generally speaking, we don't short companies on what we think to be valuation. We've always insisted on overvaluation combined with some kind of deterioration. On the other hand, about 3 years ago, which we thought was 4 years into the building of this, we'd managed to miss the whole first 4 years of it and a lot of appreciation in a lot of these, I think, questionable companies. We kind of, for whatever reason, thought we were getting towards the end of it. And we decided that if we could look at a company, none of the companies were profitable or materially profitable, and said if we didn't know what this business was, right, but we knew what the financial statements were, and we knew what the projected financial statements were, and we thought a little bit about the business, or we didn't even know what the business was, but we just looked at what the financial circumstance and future financial circumstance of the company was. If we closed our eyes and didn't know what the company did, if we didn't know if it was a, an office supply company or a paper maker or, Netflix, right? If we didn't know what it was and you just looked at all of the numbers and you said, what would you pay for the stock? And if the answer was 90% less than where it was trading, we created a basket of about 40 or 50 of these and shorted a small amount of a large number of them. And over time, at least until the beginning of this year, that basically worked out. Because even though we had 2 or 3 or 4 that really worked against us in a pretty big way, a big number of those 50 ultimately failed or derated, and the stocks went down a lot. And certainly, and the gains there were roughly enough to cover the ones that appreciated. This year, it has not been the case. Pretty much everything that's remained, or even that we've put into that basket, has only continued to go up. But the thesis on all of them is that none of them are actual viable businesses. And the market might disagree with us on this, but when they start showing real profits, then we'll take a different point of view on particular names.
Thank you.
Sure.
Was there a question over there? Yeah. The one at the back? Yeah.
Yeah, so my question is just, you've been a contrarian investor for some time. I think a lot of your investments during the bubble, during both in the .com and later on, have been contrarian, and a lot of people around you must have gone, long all the time. So the question really is, how do you sort of stick to your guns when it comes to entering a contrarian position and holding it until it works out?
Well, first of all, it's not about sticking to our guns. It's about reassessing constantly. And when the positions don't work or they go against you, the presumption is not we're right. The presumption is we might have missed something here. And so then you have to go back and think about it again and again and again and understand the other side and see if anything has changed and see if your view has changed. And if it has changed, to modify the position. And you might eliminate it or you might reduce it. Or you might sometimes increase it, but very rarely. Generally speaking, my inclination is when the position is not going well, it's more likely that we've missed something. And so the choice is generally either to reduce or eliminate it or to simply keep it if we think that it's right. So it's not but on the other hand, if we continue this way and we continue to think that we're right, then I find that patience is the way to go. And then we have to wait and let the story play out however it does while we continue to reassess it to see if in fact we were wrong, which you get both outcomes.
Okay, anyone else? Okay, right at the front here.
Thank you so much for coming today. So I want to talk to you about, for example, the voucher funds. For example, with the current situation in Puerto Rico, like many people have realized that the government indebtedness is very often exacerbated by voucher funds. That those hedge funds actually exploit the situation instead of trying to help them alleviate or refinance them. So I'm wondering how you think about that and whether that conflicts with the idea of philanthropy. Thank you.
Yeah. Generally speaking, by putting a pejorative name, vulture, on what you call a vulture fund, you've kind of convicted the suspect without a trial, right? Fundamentally, what vulture funds do is there's people who've lent money, the loan has gone bad or appears likely to go bad, and rather than lose their entire investment or continue to work through a restructuring, they choose to sell their historic investment, and it's a service to them that there's someone who's willing to buy the other side of that to let them have whatever money the market says is the right price for that. So then the question is then you have people who have expertise in accumulating portfolios or situations like that, buying them effectively at the right price, and then figuring out how to maximize the value out of the previous loans that have been made. And that's essentially what they do. Now, occasionally, you know, more in corporate situations than in government situations like you talk about with Puerto Rico, but generally speaking, you know, sometimes, you know, they try to enforce laws, or they try to work to try to get recovery. They generally operate within whatever the rules are, and I don't really see why there's an obvious social problem to this. So I'm not really sure that there's a genuine problem. But it's very easy to say, look, you paid 30 cents on the dollar for something that was initially 100 cents. Aren't you greedy by trying to figure out how to make that 30 cents into 50 cents? But the alternative, right, is to say you can't do this, and once you buy a bond, it's yours to keep. And so if you're the original purchaser at 100, and and something goes wrong and the bond is now only worth 30, well, you can't sell it, you have to keep it. You go figure out how to collect. So you get a specialization of expertise that's created through these funds.
Thank you so much.
Sure.
Okay, so in the aisle there, hand up just there.
I actually just wanted to follow up on your last point. You were talking about misses. If you look, I know you don't want to dwell on it, but if you look at your last quarter and you compare that to the returns of the S&P 500 and your note, again, we're not trying to read too much into the sarcasm. Are you going to be changing anything going into the next few quarters, continuing to short your bubble basket? If you can give some details, that would be appreciated.
Yeah. Our goal is to achieve attractive risk-adjusted returns over time while taking demonstrably less risk than the market as a whole, which means fundamentally we're not comparing ourselves to the S&P 500 or an index. And so we don't evaluate ourselves that way. Certain of our investments have worked out decently lately. Certain of our other investments have worked out less decently. And what we do is we reevaluate all of them. And some of the ones that have worked, we sell or reduce because they've worked, and we're not interested in them anymore. And some that haven't worked, we exit or reduce because we decide whatever it was that we were thinking is no longer true or is unlikely to be borne out to be true, and we modify the positions accordingly. And we do that on a position by position basis throughout the portfolio, and we do that whether things are going well for us or whether things are not going well for us. So I don't have a very good specific answer because it's just part of our ongoing process.
Thank you.
Sure.
Hand at the front just here. Yeah.
So I was wondering, what's the sort of weight or value placed when, because obviously everybody in the world is making difficult decisions because everything is much more complex. The number and significance of unknown unknowns, I suppose, or factors that you can't necessarily, you can't mitigate all risk, basically, I think is what I'm getting at. So there will always be this element of intuition or experience, I guess, which factors in. How do you sort of weigh that up versus what just the numbers and the rational and the advisors and people are saying, I guess maybe personally or maybe just more in a business context, something like that?
Yeah, the way you deal with unknown unknowns, which there are an unknown number of, but certainly exist, right? is through portfolio construction. You know, we like to run a concentrated portfolio, but even our best idea, we're not going to put all of our money in. So you have to set some kind of a limit. You have to have some kind of a risk management. You have to have some level of diversification. We have some amount of longs and some amount of shorts, and so depending on, we have a certain amount of market risk that we're willing to take on a knowing basis. And then you have the idiosyncratic risk relating to the individual investments. People say, I always say, people say like, oh, there's a stock and it's at $10 and it's got $1 of downside and it's got, $10 of upside. And I look at it and go, no, it has $10 of downside because you can lose your whole investment in any stock when you make it. We manage risk further by the level of investment that we make. We're not levered. We don't borrow more money to make even more investments. That's one way that you avoid risk, or you control your risk. If you don't have to ever repay anybody, you're not subject to lending terms and conditions. That being said, other people do things in different ways, and they have risk management tools. You asked about the financial crisis, and one of the funny things to me is one of the things that was most exposed in the financial crisis is the flaw in the mathematical modeling of tail risk and the so-called value at risk, which is a method that is used by all of the large banks and institutions. And what value at risk basically does, I'm going to digress a little bit, is it basically says, if the risk is, something that's going to happen beyond a certain level of frequency, you don't have to put any capital aside. So we're going to put capital aside to cover 95% of all possible outcomes, or 98% of all possible outcomes. But we're not going to put capital aside for really, really remote things beyond whatever the tail is, right? And I think that was one of the big problems, because what happened is people said, well, if you don't have to put any capital against it, I can take that bet an infinite number of times. So in other words, it's like if you were on the other side of roulette, the house side of roulette, and you're offering 35-to-1 odds on a 38-to-1 opportunity, and you have a rule that says I only have to put out capital for a 1 in 25 event. How much capital do I have to set aside if someone's going to bet the number 13 against me? And the answer is 0. And so since you didn't have to put any capital aside, the financial institutions were willing to take an infinite amount of risk against it. And that's how and then what happened, obviously, is a relatively unlikely, or they thought relatively unlikely happened, and there was no capital that was set aside against a tail risk that turned out to be much more likely and much more correlated than it was. So I would view that as the kind of risk management that I don't want to practice. So we take a more layer by layer, what are our investments, what is our risk on this investment, that investment, and the next investment, and we tend to think of risk as how much can we lose in our worst case. So that's why when I say there's a $10 stock, how much can you lose? The answer is not $1, it's $10, and that's the way that I think about it.
Yep, thanks.
Sure.
Shall we go to the lady just in the aisle there? Yeah, just there.
Hi. Thank you for coming. I was just wondering, because you mentioned earlier that you look at the financial statement, you give a price to the company in question and compare it to the marketplace. It sounds like something that might be computerized, and maybe machine learning can do a good job at that. So I was wondering whether you're considering integrating that. Yes. And so forth.
First of all, that's true. And second of all, what I was trying to say, though, is illustratively, which was I was trying to make a point that we generally don't sell short stocks just on valuation. But when we came to a point with certain stocks that the valuation seemed to us to be so extremely out of whack that it wasn't really a debate as to whether the stock was in a range of a fair value. In other words, it was 90% or so overvalued. You don't need a computer to help you figure that out, because you're so far off. And even if you're wrong by 100%, instead of it being 90% overvalued, it's 80% overvalued. That was the point that I was making. We do not sit around all day and try to figure out the precise value of individual stocks. We just don't do that, because those are not relevant to our actual ability to make decisions. So if we have a stock and it's $10, the goal is not to figure out if it's worth $11 or $11.50 or $12. The goal is to figure out, is it worth a lot more than $10? And since we're looking for, and not being precise about that, because it doesn't matter really whether it's worth, if we buy it at 10, it doesn't really matter if it's worth 18 or 20 or 25. And there's no point in us trying to figure that out right now, because the only decision we have right now is do we want to own the stock at 10? And if we think it's undervalued by a lot, that's good enough for us to decide to own it now. And by the time it starts approaching higher values, we can reassess and we can fine-tune our thinking on an ongoing basis. So when it gets to 15, we can say, do we still think that this is very undervalued, or 18 or 20? And sometimes the facts will change. And so if you would have if you'd bothered to figure out that it was worth 20 in the first place, by the time it gets to 15, you might decide it's worth 30. Or alternatively, you might decide, you know what? it was never probably even worth 20, it was probably worth 15. And so you want to sell it at that point. And those are the kinds of ongoing assessments that we make, but we do it in a very imprecise way, is the way I would describe it.
So it's not like template model that you guys...
No, we view these investments as puzzles, right? There are the few things that you know, but they're not the most important things because everybody knows them, right? The most important things are what is it that you can infer and how good are you assessing the possible range of outcomes, either the known unknowns or the unknown unknowns, and how do you construct that into a portfolio. And those things, I'm sure the machines have views on these, and the shorter the term of the decision, the more likely probably the machine is going to figure it out better and faster than the human. But our goal here is to find things that are just widely misunderstood by a large margin, such that we're not really competing with that kind of technology, because I don't think we would beat them. Sure.
Shall we go for the question just in the middle there? Just forward a row. Yeah, there we go.
Thank you very much. I'd like to hear your comment about the gap between the investors and companies. I think it is very oversimplified argument, but it is often said that there is a short-termism in the market. On the other hand, companies fail to justify the premium they paid for their merger and acquisition. So I'd like to hear your comments on the short-termism and how can company fill in the gap between the companies and investors?
I'm sorry, I don't understand the question. It's
I'd
the
like
gap between
the investors and companies
about
the time frame about investment or capital share repurchase or dividend. So how to
I see the idea that corporations have a longer horizon than investors do.
Investor has a, so I would like to hear the gap, how to fill the gap.
Look, I think that one of the inefficiencies in the market is investors are generically too short-term oriented. And I think that time arbitrage is one of the best inefficiencies in the market. You know, there's lots of investors that if you say, hey, this stock isn't going to go up in the next 6 months, they're going to say, well, then why should I buy it? I can wait 6 months and I can buy it then because I really want to buy it just during the period that it goes up. And that's cute, but it's also imprecise, right? And so sometimes, you know, if you have something and you know, it's either going to go up sometime in the future because you think it's undervalued, but all the other investors say, I'm not going to buy this because it's quote unquote dead money. Sometimes those are just the best investments because nobody wants them and it may work out faster than people think. And we've had that experience a number of times where people have said, hey, you've got to do that. And so some of them will work out faster and some of them will work out on time and some of them will work out later and some of them will work out never. Now, relating to the difference of opinions then between what shareholders want and what companies want, there's a natural tension there, but there's also a large agency difference, right? Because the career and the incentives of corporate managers is not always aligned with value creation, and it's not always a question of the investors being on the short term and the management being on the long term, right? If the management's job is to simply make sure that the company is solvent, right? Because as long as they're solvent, they'll get their pension, then there's no incentive to ever take any risk, right? And you do run into managers where that's essentially their agenda. There's other times where you have a company that has a well thought out strategy that's going to create compounding value over a period of time and needs its capital for whatever it's doing and to just have time to do its research, its development, its market growth and so forth and execute its strategy. And the management should essentially be left alone to do that. And so I view that as there is a tension there and it should be looked at on a case-by-case basis. And sometimes the shareholders who are suggesting change or would like to see things that might improve the value of the company are right, and sometimes the managements are right. And I think you look at it on different cases. When we get involved, which is very rare in terms of pushing an agenda, our view is invariably that if it doesn't help in both the short term, the intermediate term, and the long term, then it's not a good solution to what the problem is. And so the few times that we've stood up and advocated for something, we've been of the view that it would be beneficial to the company regardless of what the horizon is.
I think we've got time for one more question. So shall we go right to the back corner?
David, I don't know if you watch Billions. But how representative is it of hedge fund life?
I do watch the show, and it's really entertaining.
Okay, so with that, if everyone would like to join me in thanking David for coming and speaking to us all here tonight,